I'm here today to tell you where to park your cash in your portfolio for the highest return. Now, you can get this full report that tells you exactly where to park your cash by signing up to receive our podcast weekly via the link below. It is fully free, so take advantage of that. So what is this report? There you can see it. This is the one right there, which our clients got 3 weeks ago and you can access today. It is a special report on it's essentially where we take a quick look at the most effective and highest paying investment vehicles to invest the excess cash in your investment portfolio. We focus on safe, highly liquid investments where you can park your excess cash primarily within a discount brokerage account. Now, why do we do this? Well, frankly, because we kept answering client questions on the topic, and because most Canadians are not getting good advice on where to invest the excess cash in or out of their portfolios. More on that in a second. With interest rates moving significantly higher over the past year, returns on your cash are far better than they were for the balance of the past decade. So who is this report for? Well, this can apply to someone who is just starting building their portfolio on their journey, or those with an existing portfolio that hold between 5 to 10% cash, or those who were fully invested but have recently sold shares in a company and need to place some of that excess cash while they look to redeploy those funds. Now, because Keystone's portfolio building strategy includes building the equity or stock portion of your portfolio systematically over an 18 to 24 month period, the question of where to park your cash while constructing a stock portfolio is far more relevant than if you're with a traditional advisor, which deploys all your cash via ETFs, mutual funds, and stocks at one point in time. We call this an unwise strategy. Now let's circle back to the rates for a moment. This chart shows Bank of Canada's overnight rate for the past 10 years. As you can see, the current rate is 4.5%. It's far superior to any other period, particularly early in 2020 to early 2022, when the rate was basically zero. Now, the amount you can earn on your cash matters again, and Canadian investors not paying attention to this are losing out. So let's look forward here. To be blunt, we find that many traditional big bank advisors are not doing a good job placing their clients' excess cash in highly liquid, higher yielding investments. We have seen this in many portfolios over the past several months, and we can confirm this. Why? Well, let me speculate for a moment. Banks are essentially incentivized to give you the lowest rate possible and lend out your money to other Canadians at the highest rate possible. For banks, this is how they make their money. It is all about the spread, that spread between the two. The higher the spread, the better, period. Even if they have the investment products that will pay you more, some will highlight in this report, and I'll talk about today. In most cases, they make them tricky for the average Canadian investor to find. 3 of the big banks even block investors in their discount brokerage accounts from even accessing some of the highest paying cash type ETF investment options we found in our report, which is frankly ridiculous. Now, what type of investment vehicles did we look at in this report? Well, we focused on investment savings accounts, or ISAs, T-bills, GICs, and cash type ETFs. Today, I'm going to highlight and define investment savings accounts and cash type ETFs to find the highest return for the cash in your portfolio. Let's start with some notes on investment savings accounts. What are they? They're essentially purchasable through a discount brokerage using its respective fund code like a standard mutual fund. Like a normal bank account, the interest rates are variable with no restrictions as to when they can change. So, if we continue to see the Canadian policy rate move higher, these accounts will likely rise as well. And similarly, if the policy rate were to fall, the interest rate received would fall as well. However, increases and decreases do not absolutely follow the policy rate. They are still subject to competition between banks and supply and demand from depositors. However, there are some cons compared to normal savings accounts. You will likely need to wait what is called T+1 for your settlement, meaning you will need to wait 1 day to withdraw your money, as well as waiting 1 day before your money starts to collect interest. Not that this is much of an issue, but we want to point it out. Additionally, you may need to invest a minimum amount, usually a lower threshold, but it's something to be aware of. A couple of last notes on investment savings accounts. You can also deposit US dollars in an investment savings account. You may receive a different interest rate compared to the Canadian dollar accounts, as US dollar accounts are based on the US interest rate. Now, Canadian and US interest rates are currently and historically close and move similarly, but there is no guarantee that will remain true. Investment savings accounts pay higher interest than normal savings accounts. The Big Five banks' products currently range from between 4.05% to 4.5%. Now, banks will also commonly restrict you to only purchasing their investment savings accounts, which again is a shame. But to summarize on ISAs, essentially what you're looking at here is the best return that we can find right now is about 4.5% in this category. The pros are higher returns. They are CDIC insured up to $100,000. The cons here may be specific to that broker or bank that you're using. They are tradable only during certain hours depending on the broker. And the other thing to keep in mind here, the interest rate is variable. We find they are best for small and frequent deposits. Let's look at those high interest deposit ETFs. Now, the basics of this category: exchange traded funds, or ETFs, are traded like stocks, but are managed similarly to other funds like mutual funds. There is an array of high interest savings ETFs, but the following all function in the same manner. The fund manager collects hundreds of millions or even billions of dollars and then places the funds in high interest savings accounts at various chartered Canadian banks. As the funds are depositing significantly more than the average person, they are able to gain preferential rates, essentially higher rates, from the various banks they deposit at. Like a normal savings account or savings investment account, the investor rates are variable. They can increase or decrease with prevailing rates. However, these ETFs are not covered by the CDIC, like investment savings accounts, which I just talked about above. So if a bank were to default, you could be at risk of losing a portion or all of your holdings, however unlikely that may be. Let's look at 5 popular high interest deposit ETFs. For these ETFs, forward yield is the current rate of interest on the underlying savings account. Trailing yield will differ from forward yield as it is what was actually received over the past year. ETFs conduct monthly distributions of interest. As well, they pay a distribution that will reset the price of the ETF to, say, $50 once the date of record occurs. By resetting the price, you will have little or potentially no capital gain or loss once selling. Net yield is the yield less the management expense ratio, or the MER, which you can see there in the final column. In this category, there is another option. If we look here, it is the HSAV on the TSX. Forward yield right now is around 4.88. Essentially, the HSAV does not pay monthly distributions and instead accumulates funds, which allows for long-term compounding. It shifts the taxation from interest income to capital gains, which is more tax efficient and can delay the taxation if held for long periods. However, HSAV tends to have a larger variance from its net asset value due to no capital being returned. Additional notes here to take into account in terms of these high interest deposit ETFs. Depending on your brokerage, you may be charged a fee for buying and selling your ETFs like a stock. Trading fees can substantially impact your return, particularly if you're investing a smaller amount. Example here, if you are charged $10, for example, in your discount brokerage account to buy or sell, buying and selling the ETF costs you $10 for each transaction for a total of $20. Now, if your principal invested, for example, is $2,000, the $20 trading fees are 1% of your principal, resulting in about $1,980 actually being invested. Let's say you're receiving an additional 0.5% over the net yield on one of the investment savings accounts, which I highlighted above, which have no trading fees. it will take a holding period of just under 2 years invested before an ETF produces higher returns compared to the investment savings account options at this smaller amount of around $2,000. Whereas if you invested $200,000, a larger amount, an ETF's higher yield would produce a higher return in less than 2 weeks. So in this investment vehicle, size matters. If you are investing lower amounts and want liquidity, an investment savings account could be a better option. As well, since fees are on a per transaction basis, if you're regularly adding to your position, you will need to account for the additional fees. In summary, on these high interest deposit ETFs, simply put, smaller and more frequent transactions will produce lower returns than a single large purchase for ETFs. If you wish to do frequent and or small transactions, an investment savings account is likely the better option. ETFs can potentially deviate from net asset value, but for this type of ETF, the deviation is normally plus or minus 2 cents as market participants actively arbitrage these securities, meaning there is lower risk of the security deviating from the underlying deposit value, but not no risk in some names. Now, due to trading as an ETF, buying and selling is only available during market hours. So if you believe you want to access these funds on a weekend or holiday, ETFs may not be the best choice for you. We see right there the top rate at present is in the range of 4.88%, which is a strong return on your cash. You can get our special report today and find out more details. It's free. Finally, we have discovered that some brokers may restrict you from buying these ETFs to push you to buy their own investment products. Surprise, surprise from the Canadian financial industry. Specifically, TD, BMO, and RBC discount services are known to block these products, which is unfortunate and not in the interest of you as a loyal client. Again, click the link below, sign up for our podcast, and learn more about stocks, investing, and products like these, and get this report for free. Thank you, and profitable investing.